When you look at the marketing for almost any major product, whether it's a flagship smartphone, an electric car, or a mortgage, the manufacturer always wants you to focus on one headline specification. They want you looking at that shiny number. In the tech world, it might be the megapixel count on a camera or the horsepower of a motor. In the mortgage industry, it is almost exclusively the interest rate. Most homebuyers in the DMV focus so much of their energy obsessing over securing the absolute lowest interest rate that they completely miss the thousands of dollars hidden in the fine print. Specifically, they miss a tiny section on their official loan estimate document called Box A. These are often bloated, unnecessary junk fees that do absolutely nothing to improve the quality of your loan, but do everything to pad a retail bank's profit margin. I'm Choe. I'm a mortgage broker based in the DMV, and today we're going to be doing a complete teardown of the loan estimate document. I'm going to be showing you exactly how to identify these junk fees, how to mathematically strip them out, and how you can take that saved capital and use it to engineer a significantly stronger offer. Let's get into the teardown. To understand how Box A works, you first have to understand the mechanics of how a retail lender markets their products. If you go online right now and search for mortgage rates, you're going to be seeing some incredibly attractive numbers. You might see a rate that is 0.25% or even 0.5% lower than the national average. But here is the reality check. The mortgage market does not work like a clearance sale. Mortgage rates are tied to the bond market, specifically mortgage-backed securities. The underlying cost of the money is largely the exact same for everyone across the industry on any given day. So if a massive retail lender is offering you a rate that seems drastically lower than the baseline, they aren't losing money on the deal. They're just shifting the cost from the rate to the fees. They used a teaser rate to get you to pick up the phone. Once you are in their ecosystem, they issue you a standardized federal document called a loan estimate. And page 1 gives you the summary, your rate, your monthly payment, and your estimated cash to close. Most buyers look at page 1, see the low rate they were promised, breathe a sigh of relief, and blindly sign the paperwork. But the real story, the actual cost of the money, is on page 2, you guessed it. Page 2 is where the closing cost details live. And the very first section on the top left of page 2 is Box A, titled Origination Charges. By legal definition, origination charges are the fees that the lender is charging you to originate, process, and evaluate your loan. If you look at the quote from a standard retail bank or a massive high-volume call center, Box A usually is packed with line items. You will see things labeled such as administration fee, processing fee, probably an application fee, or even a commitment fee. Let's be incredibly objective about what these fees actually represent. These are corporate overhead costs. When you go to a massive retail lender, they have thousands of employees. They have layers upon layers of middle management, massive national marketing budgets, and shiny corporate skyscrapers. They pass the cost of that heavy infrastructure directly onto the consumer by hiding it in Box A. It's very common in the DMV market to see these junk fees add up to $1,500, $2,000, or even $3,000. And that's cash coming directly out of your pocket at the closing table. It doesn't go towards your down payment. It does not buy down your interest rate. It simply goes to the bank's bottom line. Now, there is one item in Box A that's completely legitimate, and we need to distinguish it. That is points or discount points. A point is an upfront fee you can choose to pay permanently to lower your interest rate over the life of the loan. Paying for points is a mathematical strategy. It is calculated decision based on your break-even horizon. Paying a $1,200 admin fee, on the other hand, that's not strategy. It's just bloatware. To fully understand why Box A is the primary problem, you have to look at the rest of page 2. Right underneath Box A, you have Box B and Box C. Box B contains services you can't shop for. This includes things like the appraisal fee, credit report fee, flood certs. These are third-party costs. The lender does not keep this money. They simply collect it to pay the appraiser or the credit bureau. Box C contains services you can shop for. This is primarily the title insurance, the settlement agent fees. Again, the lender does not keep a dime of this money. You actually have the legal right to choose your own title company. So when a lender tries to tell you that closing costs are just inherently expensive in this market, you need to push back. The third-party costs in box B and box C are going to be virtually identical regardless of which lender you choose, because an appraiser in Bethesda costs the exact same amount no matter whose logo is at the top of the paperwork. The only section of the loan estimate where the lender has total unilateral control over the pricing is box A. That is the variable you must isolate. By the way, once you've cleared and cleaned the specs on the loan estimate, the very next step is actually engineering your timeline so you can close your loan faster. I put together a free 19-minute masterclass that shows you how to flip the traditional mortgage process upside down and get fully underwritten upfront to beat cash buyers. I'll leave a link in the description if you want to check it out. But back to the loan estimate. So let's talk about what the standard should actually be. If a bloated box A is the glaring flaw in the retail mortgage process, what's the fix? What should the benchmark be when you're interviewing a mortgage professional? Well, you should be looking for a mortgage advisor who operates with what I call a clean box A. Because a mortgage broker doesn't have the massive corporate overhead of a retail bank, because we shop your loan across dozens of wholesale lenders, the standard we look for is a loan estimate with 0 admin fees, 0 processing fees, 0 commitment fees. For example, here at OneRate, that's exactly how we structure your files. The goal is to strip the bloatware out of the quote, but stripping the fees is only half the benchmark. The other half is how your file is handled before you bid. You should demand a highly analytical approach upfront. It's not enough just to get a cheap quote. You need certainty. As a broker, we don't officially underwrite the loan. The official underwriting only happens after you have found a house and have a ratified contract with the seller. What a proper upfront audit does is simulate the exact underwriting environment in advance. We take the W-2s, your tax returns, your asset statements, your credit report, and we audit them line by line against Fannie Mae and Freddie Mac's guidelines. By running your file through those exact guidelines early, we identify the red flags before they become a problem. We ensure your debt-to-income ratio is calculated perfectly. We do the heavy lifting before you ever step foot into an open house. So when you combine a clean box A with a rigorous upfront audit against those guidelines, you completely change your posture as a buyer in the DMV. Let's look at the math one last time. If you strip $2,500 worth of retail junk fees out of your box A, that's $2,500 that stays in your bank. In a hyper-competitive market like DC, Northern Virginia, that cash is a weapon. You can use it to cover a partial appraisal gap. You can keep it in your reserve to make your financial profile look even stronger to the automated underwriting system, or you can just simply leave it in your savings account to weather the first few months of homeownership. The point is, the money belongs to you. It should be used to build your wealth, not to pay for a bank's marketing budget. Now, a quick reality check. You should run away from any lender who guarantees your loan upfront. In this industry, there is no such thing as absolute certainty until the loan is officially clear to close and the funds have been wired to the title company. What a proper upfront audit does is it provides a mathematical confidence. You know that once you have a ratified contract, your file is clean and prepared to move rapidly through the actual underwriting process because the obvious math problems were already solved. You aren't operating on a guess. You're actually executing a benchmark strategy. So the verdict on box A is simple. It's the most overlooked spec in the entire home buying process. So stop, staring blindly at the interest rate. Turn to page 2 of the loan estimate and look at the origination charges. If you see admin fee or processing fee or commitment fee, you're looking at bloatware. You want to see the exact blueprint for how we take a clean file, flip the traditional timeline, use the upfront underwriting blueprint, and generate a 15-day close that competes against those cash buyers. Well, then, go watch the free masterclass in the link below. Grab a notepad, learn the strategy, and demand a higher standard for your mortgage. I'm Choe. Thanks again for watching. I'll catch you in the next one.